What's up, guys? Today we're going to do some stock analysis. We're going to look for a good deal on a company today, and I did a little bit of, I guess, preemptive work before this video to try and keep the time of the video down, but I just want to show you a way you can do this without knowing a whole lot about the stock market, but of course it's helpful. Obviously, the more you know, the easier it is to analyze these type of things. So I came to TradingView, which, I mean, to get here, you can literally just go to like Google and type in tradingview.com, or you could even type in oversold stocks, and you'll probably, yeah, first thing that pops up, right? Takes you to this page. All right, so I'm going to close this because so what I did is I went to that page and I went to large caps. And large caps are giant companies in the United States that have a high market cap, which means they're pretty reputable, generally speaking. There's a lot of money in those companies, and they're dealing with a lot of money. For people that have less experience, these are like your blue chip stocks, and there's less risk here, right? So we're looking at long-term investments today, and we're trying to get a good deal and a good price on a long-term investment. So I went through this list and kind of like looked for a good opportunity already, and I found these guys. And the way that I knew this was probably a good deal, right, is the RSI, which is the relative strength index over the last 14 days. What this is saying, relative strength index is where's the price now and expected to where it should be over the last 14 days. And 50 would be like that middle ground, okay? 80 would be it's too expensive, and 20 would be wow, this is really cheap, right? So 20 would be like oversold, people are dumping it more than they should be, and then 80 would be like overbought, like this is overvalued right now. So you don't really generally want to buy something when it's at 80. This isn't a law, but generally speaking, you want to try and get stuff under 50 because it's a better deal in compared to where they're expected to be in the short term. So, I also know a little bit about Broadcom, and Broadcom is a leader in the AI space. I mean, they are, you know, attached to these guys, and you can see these other companies that are up here with them. Like, they're no slouch. These are very Broadcom's a very big company, and they've been around for a long time, and they're like 118th on the Fortune 500 list, so they're just outside that top 20%. And if we go in and look, so we know they're cheap for the last 2 weeks, right? And I also pulled up the chart on them, and we do see a double top here, which you can learn about that. So that kind of indicates in the short term we might actually see it come back down here a little bit, which, there's no rule for that. We are seeing some price consolidation here, and we do have earnings coming up soon, right? So we might get a huge sell-off there, or we might get some explosive growth depending on how that goes. It's really hard to say. That's in like 3 weeks. So maybe you wait, but I'll tell you why I'm not going to, because here's their forecasted growth. The minimum case, right? So analysts are saying, worst case, over the next year, the price will be down $3 from where it is today. That's pretty low risk, right? You're losing $3 a share, which is like, I don't know, what is that, 2%? I don't even know. I'm not going to, yeah, right around 2%. Yeah, 2.27. It's literally there on the screen. Anyways, so that's pretty low risk to reward versus a potential max return of 46%. Now, again, take this with a grain of salt. These are just analyst projections. No one actually knows where the stock market is going, but these guys know more than you and I do, and they spend all day analyzing this stuff. So you also look at their reported earnings per share over the last several quarters, right? So we're going back 2 years here. It's done nothing but go up the whole time, and they're forecasting more of that, and they have actually beat. The blue is what they actually did, and the gray is what they expected. In every single case, they beat what they expected by just a little bit. So if they can forecast this much growth ahead, and they've actually been outperforming their expectations, that's a really good sign. The same is true with revenue, right? So these guys are on track to do some crazy numbers, and they're part of the AI boom, which in my opinion, we're still in the infant phases of AI. And that is going to play out into like 2030, 2028, 2030, somewhere in that time frame. I'm a computer science major, so I kind of am involved in that space. So I do have a bit of background knowledge here, but I mean, you could learn about this company literally just by Googling it or going to this news section and reading about what they're doing, right? So, anyways, great numbers, great forecast, okay? But this is what really sold me on them. Is that you go to seasonals, okay? I don't know why this isn't loading. Let's try refreshing it. Load. Huh. This was working 5 minutes ago. Oh, okay, well, I still have it up on this, so we got lucky. I don't know what's going on with that, but seasonals is like their performance, okay, over the last, like this is their growth. It's showing you their growth year to date, and it's showing you by season, like by year, right? So if we look 2023 versus 2024, look at this. The seasonality is pretty consistent. So we in 2023 we saw a sell-off going into December, and then explosive growth. Like we went from 63% all the way to 107% at peak, which is huge, right? So in December they did good last year, right after a short-term sell-off, and that's because retail holiday, like people are spending money. It's not that surprising. All right, so let's check the last year. Oh, look at this, 2022, not as pronounced, but same thing. Like it's kind of started a little bit earlier, but in November into December, we just saw nothing but upside, which if you know anything about stock market, that's pretty typical. This time of year is usually really good for stocks. Same thing in 2021, same thing in 2020, same thing all the way back in 2019. We're going back to way before AI was even relevant now. So the seasonality is telling me that now is a good time to buy because we can expect growth, and we're getting them 8% off their high, like 8% on sale. I think that's how it worked out. Let me check that again. So here's their high here. Let's check the bottom here. 13% off their high, actually. And I think it's 8% on the month is what I was seeing earlier. So you're getting a 13% discount basically from their all-time price with absolutely tremendous expected growth. Everything here tells me to buy these guys. Now, I do want to say they're in the middle of a sell-off. This could definitely go deeper. So you have to understand there's risk with this stuff, and you're buying this company to hold it. You have to be okay with seeing red for a while. But the long term, from a long-term standpoint, this investment looks great, and you're not overpaying. That's the biggest thing. And then they do have earnings in about 2 weeks. So what I would expect to happen, just based on watching the AI craze like the last couple months, because of the seasonality, I think they're going to hit this earnings period and it's going to explode. That's my guess. But there's a chance that they hit this and they miss or something, and then you see a giant sell-off, right? That doesn't mean that it's just doomed. It means in the short term, you should buy more, because after everything you just analyzed, this is a good investment over the next year at least. Again, going back to the forecast, you can see most analysts' minimum projection has this thing falling $3 from its price today. Worst case, by a year from now. That doesn't mean it won't go deeper and then come back, but you're basically getting it as cheap as you probably can by the end of next year today. So very, very low risk on that analysis. Again, got to take all the forecasts with a grain of salt. If we go to war, all this goes to shit, right? Investing is risky. You can lose all your money. Don't put more money in the stock market than you plan on. Don't put more in than you're okay with losing, and take portional risk and use risk management. Like, you can set stop losses on your stocks where if you lose 20%, it just automatically sells it. I don't suggest doing that, but you can. But those days are the days where you make your best money because you just buy more, right? If you're buying good companies, you shouldn't be afraid of sell-offs. You should just use them as opportunities to accumulate more of that company. So that's what we're seeing here. We're seeing a huge sell-off off the back of NVIDIA's earnings. Like, this isn't even anything to do with them. It's because NVIDIA reported earnings, and this is a reaction from Broadcom. So if we look at NVIDIA, I bet you, let's see. Yeah, so it's like an inverse movement, right? So they are, in a way, competition with each other, and that's what that That's what that is. So when they get their earnings, NVIDIA's earnings was good, so we can expect with them being in the same sector, their earnings are probably going to be great too, and then this is going to get corrected. That's why I think this is a great opportunity, and I'll be buying some of these guys today. Hopefully some of what I talked about here helps. I'm just trying to do weekly stock analysis and maybe give you guys a pick. None of what I say is financial advice. Please don't buy this stuff if you don't feel comfortable with what you're doing. I'm not telling you to buy Broadcom. I'm telling you I will be buying Broadcom today, and I showed you why. I hope this helped, and have a great day.